So, welcome back. So we're still busy with this data visualization, and we're now on to the line chart. So line chart is something we're very familiar with. We've all seen many line charts before. So all we do is we plot all the data points against the horizontal and the vertical axes, and then we just connect the points. And what's nice about this is that we can then see, what is the underlying trend in the data. So if we take this example here, we're going to look at the Riverside retail share price against the retail index for the first 15 days of June 2021. So let's start with the Riverside retail price. So this is the solid line over here, the orange line. And we can see on the 1st of June, the share price was there $10.70, let's call it. And the Riverside retail price is along this y-axis or vertical axis over here. So let's call it Y1, because we've got a secondary y-axis we're going to talk about in just a minute. And this is Riverside for Riverside retail, this y-axis. So let's call it RR. And then we can see on the 2nd of June, the share price closed, let's call it $10.90. So we do that for every day. What's the closing share price for each day? And we just connect the dots. And then that's going to give us our line chart, nice and easy. So we can see what the trend is. So we can see we started at $10.70 on the 1st of June, and we ended there up at $11.60 on the 15th of June. So the share price did quite well over those 15 days. So now if we want to compare, how has Riverside Retail done to its competitors, we need to compare it to its sector. So now we need a secondary y-axis. So let's call this is the secondary y-axis over here. Let's call it Y2. And that is now for the retail index. This will include all of the retail stocks on the stock exchange. So it'll be all of the competitors of Riverside Retail there in the index. So what we can see is that from the 1st to the 2nd, Riverside Retail share price went up, but so did the index. So most companies went up. And then from the 2nd to the 3rd of June, the index took quite a dip, and so did the share price. So in other words, this drop in Riverside Retail share price, it is sector specific. Most, or if not all, of the shares in the index went down from the 2nd to the 3rd of June. So maybe on the 3rd of June, there was an announcement that was made, an economic announcement, let's say the GDP, which is a gross domestic product of the economy, took a tumble, or consumer confidence was down, or unemployment was up, or something. So unemployment got worsened. So something like that caused all of the stock or the index to fall, and Riverside Retail as well. But what's interesting to note is that from the 4th of June up to the 15th, we see a recovery. We had a few days of fall because shares don't go up in a straight line, but we see overall the share price of Riverside Retail actually recovered nicely, even went up from where it started on the 1st. But look at the index. The index didn't really recover. So what we can see is that Riverside Retail have outperformed the sector. So they're doing better. They must have better products than the average company then in the index, right? A better company than the average company, it would seem. So overall, the Riverside Retail share price started there and ended up there, whereas the index started over here, which is at 5,000 points. So these are in points. So the indexes are what we call in points. So the index started at 5,000 points, and it ended on the 15th at, where's that? That is about 4,970. So the index had a bit of a fall over the period, whereas the share price went up. Right, so Riverside Retail is doing well. Okay, so then I just made a note down the bottom over here that, remember, the frequency polygon and the cumulative frequency distribution chart that we did in the previous class, those are line charts, and they are used to represent what? Remember, those represent data frequency distributions. Great. And now we're going to look at a bubble line chart, which sounds like some fun. So here, the data points are now replaced with varying sized bubbles to represent a third dimension of the data. And the bubbles can even be color coded, which makes it even better. So if we just go back here, with our normal line chart here, we just have the data points like this, all the same size, and we just connect the dots, and we don't even see the dots really once we've drawn the line over them. But here we're making a big deal of the data points. We're making a big deal of them. So let's try this example and we'll see what's going on. Here we've got the half yearly revenue, but not only revenue, we've also got the earnings per share listed in this column of Fab Firms. So we can see in the first half of year one, the revenue was there 636. So it started over here 636. Then it went up. In the second half of year one, the revenue grew to 671. So it went from there 636 up to 671. So we've got the revenue here along this y-axis. Let's just call it R over there. So there's our revenue. And then we can see it's in the blue line. It had a nice jump there from the first half of year one to the second half of year one. But now we are not only plotting the revenue, we're plotting the earnings per share as well. And the earnings per share is represented by bubble size. So the earnings per share, which is just the earnings, which is the profits, is the revenue minus the cost gives us the earnings. To get it to earnings per share, we just divide the earnings by the number of shares. It gives us the earnings per share. We'll talk a lot about this when we do financial reporting. And this bubble size over here, the $1.56, that's representing the $1.56. But we see in the second half of year one, the earnings per share went up from $1.56 to $1.68. So this bubble is bigger than that bubble because the earnings per share went up. So we can see that that's representing larger earnings. So if we have profit, we've got green bubbles. The bubbles can be color coded like we said there. So there we've got nice green bubbles. But in this first half of year two, there was a bit of a wobble here. The revenue took quite a drop. And then once we've taken off all of the expenses from the revenue, we actually come out at a loss. The earnings per share is in a loss. So now we need to show that in a red color. So, but it's only 54 cents. So it's quite a small bubble, but it's red nonetheless. But then the good news is in the second half of year two, we had a nice jump in revenue, and now the earnings per share is shot up quite nicely. So we can, so the costs must have come down as well because the earnings per share are higher than they were even over there with lower revenue. So they're doing well, they're cutting costs. So this bubble over here for the $2.04 earnings per share, this is now the biggest bubble because it is the biggest earnings per share of all of them. Great, so that's a very nice chart. Okey-dokes. So now the last thing we need to look at in this class, we'll take a few slides though, is the scatter plot. So what is a scatter plot? So it's a type of graph for visualizing the joint variation in two numerical variables. So what's good about this is that it helps us to understand potential relationships between the variables. So we do it by drawing dots to indicate the values of the two variables plotted against their corresponding axes. And if we take this example, we'll understand what's going on. So here we've got a scatter plot of the monthly financial sector index returns versus the S&P 500 index returns over 2 years. So if we've got monthly returns over 2 years, so that's going to be 24 dots. There should be 24 dots. If you count them, there'll be 24 dots over here. So the S&P 500, that is an index in America of the 500 biggest companies that trade on the New York Stock Exchange. So we'll talk more about that when we get to equity. So these S&P 500 includes all sectors. So it won't only be financial, there'll be IT stocks in there and retail and industrial and resources and consumer staples, and everything will be in the S&P 500. So we can now compare, how are the financial stocks doing against the S&P 500. So the S&P 500 is here along the horizontal or the x-axis over there. And the financials are here along the vertical or the y-axis. So let's just call that the y-axis over there. So what we can see is that when the S&P 500 is doing 4% out here, then the financials are doing their 4.1. So they both, when the S&P 500 is doing well in that whatever month that was, then the financials also did well. And when the S&P 500 was down over here, -2, let's call it -2.5, then the financials were at -3. So we can see, that when the S&P 500 is doing well, financials are doing well. And when the S&P 500 is doing badly, like down here, then the financials are also doing badly. So we've got quite a strong relationship between the financial stocks and the S&P 500. In actual fact, and we're going to see this on the next slide, we can actually draw a line in between this, and that line is, if we can draw a line in our dots or our data, that always indicates a strong association between the two variables. And we do have an outlier over here, which we call an extreme value. We'll see that on the next slide. We call this an extreme value because in this outlier here, the S&P 500, let's say it did 0.5%, but the financials, they did 3.5%. So the financials way outperformed the S&P 500 in that particular month, whatever month it was. Right, but now if we have a look on the right-hand side here we got a scatter plot of the monthly the real estate sector index returns against the S&P 500. And these dots, they're all over the place. So for example, here, in this month, the S&P 500 did nearly 4%, but the real estate index did less than 1%. It only did about 0.5%. In this month down over here, the S&P 500, in this month here, the S&P 500 did -2.5%, but the real estate index did, or real estate sector did nearly 1%. So these dots are all over the place. Let's take, for example, let's try another one over here. So this one, the S&P 500 did just only 1%, but the retail, a big part of the real estate sector did over 3%. So we got no association between these dots. We can't draw any line. So there's a very weak association between the real estate sector and the S&P 500 index. Great. So what we're going to now add on to what we've said over here. So we can use these things to check for any potential association between the two variables. So if we look back at the previous slide, the left-hand block, the S&P 500 versus the financials, the data points, they align along a straight line, like the line I just drew in there. So that means if we can do that, there's a significant relationship between the two variables. And if we've got a positive slope like we have, this means that we have a positive association. So what does that mean? It means the variables move in the same direction, like we saw. When the S&P 500 was doing well, then the financials were doing well. When the S&P 500 was doing badly, the financials were doing badly. If we had a negative slope, that would mean a negative association, and there the variables would move in opposite directions. So we are going to come back to scatter plots in another class, in a few classes time. So we will be revisiting this then. And then the strength of the association, this can be determined how closely the data points they clustered around our line. So our clustering was quite tight for this S&P 500 versus financials. And then what does that mean? It means we've got a strong relationship. If we had loose clustering, then that would mean a weak relationship. And if we go back and look at the S&P 500 against the real estate, there we said that scatter plot that has got randomly distributed data. The data points were all over the place. We couldn't draw a line anywhere. We couldn't draw a straight line there anywhere. So that means there was no clear association between the two. And the other thing we can use a scatter plot for is the data points located towards the ends of each axis. That represents the data range. And we know what the range is. We will also look at it in a class coming up. We know what range is. It's just the difference between the maximum and minimum value. So let's have a look at the range over here for the S&P 500. So our lowest value was -2.5 over there for S&P 500. And then the highest we had was close to 4, let's call it 3.9%, that one over there. So that's going to be the range for the S&P 500. And then what about the range for the financials? Well, the financials, the best month there was just over 4%. And the worst month was over here. Let's call it -3 there. So that was the, oopsie, sorry about that. That was the range there for the financials, just over 4, although the worst month there, nearly -3. Okay, that's fantastic. And then another thing we can do, if we examine the scatter plot, we can find extreme values, or what we call outliers. So an extreme value is an outlier, and you may have spotted one on the previous slide, where this one over here, there we have an outlier or an extreme value. Why? Because the S&P 500 for that month was only doing, let's say, 0.5% there, but the financial sector, that did 3.5%. So that there we have quite a big outlier. Okay, and as promised, we will come back to these outliers in another class. Good. And now we need to look at what we call a scatter plot matrix. So what is this? Okay, so with a scatter plot matrix, what it does, it organizes scatter plots between many pairs of variables and allows us to inspect all pairwise relationships between all the variables. So we're going to take this exhibit here to explain this. So this exhibit, it incorporates 4 variables. So we've got the index returns for the S&P 500, which is the index of all of the stocks. So the index returns for the S&P 500, and for 3 sectors, the IT, the utilities, and the financials. So in the top over here, we've got how does for example, we're plotting here the S&P 500 against the IT stock. So we can see we've got quite a positive relationship there. You know, when the tech is doing well, the S&P 500 is doing well. The tech is doing badly, the S&P 500 also seems to be doing badly. But if we look at the utilities, there's no relationship here. We can't draw any type of a straight line in these dots. So for utilities, there's no clear association between the S&P 500 and utilities. So utilities are, if you're not aware, are things like electricity companies and water companies and those kind of things. Right. And then with financials, we can see also there's quite a strong association between the S&P 500 and the financials. You can also draw more or less a straight line there. Okay, so then what we can, let's just have a look at a couple. Now in the matrix, we don't obviously have to draw the matrix on the exam, but if we want to look at a relationship, say between, one example would be between, what's the relationship between IT and financials? Well, there seems to be quite a strong relationship here between IT and financials. But if we look at what's the relationship between IT and utilities, well, nothing. We can see there's no clear association between IT and utilities, because we can't draw any type of a straight line there. And you can do the same. You can look at the association between all of these, and that gives us our scatter plot matrix. And then lastly, you would have noticed here we've got these things look like our histograms from before. So the matrix, it includes univariate frequency distribution histograms for each variable. So for example, here we've got, if you've got IT and IT on this on the y-axis there, or the vertical axis, and IT there again on the x or the horizontal axis, then we actually end up with a type of a frequency distribution histogram. There's utilities, and financials. Great. And then what we now need to look at is the heat map. And what is a heat map? So a heat map, it's a graphic that organizes and summarizes data in a table. So the data is then represented using a nice color spectrum. So if we take this example, it'll clear everything up. And so here we've got frequencies by sector. Remember what we did before? We looked at the frequencies by sector, but not only by sector, which is our sectors are these here, the IT, the financials, the consumer staples and materials, but also by level of market cap. So the market cap is the small, mid, and the large caps that we did before. So what we can see is that if we've got a small number, we've got it in red. The tens are in red. The medium, the mid-range numbers are in like a yellowy color, 20s, and then this is the big one. A big number is there in green. So what's great about the heat map is we can quickly see, what is our biggest subgroup. And we know from the class before that our biggest subgroup was the mid-cap IT stocks, and there they are again there in green, the biggest subgroup. We can quickly see there are 40 mid-cap IT stocks. So other than using these heat maps for displaying frequency distributions, they're also used to visualize the degree of correlation among variables. And we are going to talk about more about correlation a lot more in future classes. Right, so the last thing we need to look at in this class is how to select amongst the visualization types. So we've looked at quite a few types. So to decide which chart to select to visualize our data, what we must always ask ourselves is, what is the intended purpose? That is the most important consideration that we need to have. So we must ask ourselves, is the purpose for exploring and or presenting relationships or distributions, or is it to make comparisons? So let's start with this one first, exploring or presenting relationships or distributions. So let's say we want to explore or present relationships. So this is this one over here. So let's just tie those two together. So if we want to explore or present relationships, what we can do is the scatter plot. That would be for two variables like we've just looked at. Or we can do a scatter plot matrix if it's for multiple variables, which we also recently looked at. And then we can also do a heat map. And that, I guess we can take that bullet out there. That is if we have multiple variables. Now, what happens if we want to explore or present distributions? So these are over here. So if it is numerical data, like we did a few classes ago with our Riverside retail, the returns on the Riverside retail shares over the 10-year period, then that was numerical data. And then we remember we did the histogram, we did the frequency polygon, and we also did the cumulative distribution chart. But if we've got categorical data, like we looked at, we had 200 shares, and then we had some shares in the IT sector and some in the financial sector and some in whatever other sectors they were. There we did the bar chart, and we also did the tree map, remember, with those rectangles. And then we also just now looked at, we can also look at a heat map. But if we have unstructured data, like textual data, there, remember, we did the word cloud, right? And then the last one is this one here. What happens if our purpose is to make comparisons? So if our purpose is to make comparisons, we need to look at, are we making comparison amongst our categories? So, for example, are we comparing how many IT stocks we got to financial stocks and whatever the other sectors we have? There we remember we did the bar chart, the tree map, and the heat map. But if we want to do comparisons over time, that is when this is where we do the line chart if we have two variables, and we can also have the bubble line chart where we have those three variables that we've just looked at. And I got this, I just put the disclosure in there. This is from CFA Institute. And then also, just for disclosure, I think I did mention it, that this scatter plot matrix also got from CFA Institute. But just to make sure, in case I forgot to say it, I'm saying it again. Right, so now the last thing we need to look at is what the ways that these graphs can be misleading. So this is number one. Data, sometimes it can be presented with an improper chart type, and that can be misleading. Why? Because we then won't be able to interpret the data accurately. So let's take an example. To investigate the correlation between two data series, if we want to investigate correlation, let's say we go and we plot the two data series separately in a line chart. That's wrong. So let's just put a cross over there. If we want to investigate correlation, what must we do? We must do a scatter plot. So that would be the correct one. So we'll give the scatter plot a tick there. If we did in a line chart, the line chart, that can't investigate correlation, right? That's an improper chart type. And then the second way that graphs can be misleading is that if data are selectively plotted in favor of the conclusion an analyst actually wants to come to. So for example, let's say data is plotted only for a short time frame, and that could be noise. That could just be for a certain, it might only be applicable to a certain time frame only. So this short time frame, this then concurs with the analyst's conclusion. But if the analyst actually did a longer time frame, it may then show a different trend. And then, so then basically the analyst has selected the data for the conclusion he wants to come to, right? And then the third way that data can be, graphs can be misleading, is where data are improperly plotted in a truncated graph. And I'm going to draw one for you in a minute, so don't stress about this funny word. So data are improperly plotted in a truncated graph where the vertical axis does not start at 0. So what if this is the case, it can create the false impression of significant differences, but in reality, the differences are small. So let's try this example here. Let's say we've got a vertical bar chart is used to compare the annual net income of company A and company B. So company A, they've got net income of $5 million, and B has got net income of $6 million. So if the vertical axis starts at 4 million, then the bar heights, that would inaccurately imply that company B's net income is twice that of company A's net income. So we're going to draw it over here to explain it. So I'm going to just draw like this. So we said that the vertical axis is starting there at 4 million. So here's a vertical axis. So we're going to start at 4 million there. And then we have 5 million there. And we have 6 million up over there. So that is the net income. So I'll just put over here for the vertical axis there, net income there. And this is company A over there. And that is company B over there. So company A, what was company A's net income? 5 million there. And company B's net income, what is their net income? 6 million there. So you see how this graph is being misleading, because it's showing here. Let's just make it, there we go. So what it is showing, what this is implying, is that company B's net income is twice, because this line is twice as long as this line. So this graph is inaccurately implying that company B's net income is twice that of A, but meanwhile, it's not twice, it's only $1 million more. Okay, so then the last thing where graphs can be misleading is where the axes, they are improperly scaled. So let's take an example of a line chart. So if we've got a high maximum on our vertical axis, what that does, it compresses the graph into an area close to the horizontal axis. And what does that do? It causes the graph to appear to be less steep and less volatile compared to if it was properly plotted, right? So that is what that is an improperly scaled graph, right? So that then is the end of that class. I hope it was helpful, and so just study hard, and I'm sure we're going to be fine, and we'll see you guys in the next class. Hello, it's Tim here again. I hope you enjoyed the class and found it beneficial. We have some classes available for free on YouTube, but we have classes for the entire curriculum. The classes that are not on YouTube can be purchased from us. If you'd like to purchase the classes, please contact us for the pricing, and I've put our contact details over here. You can purchase all the classes or certain readings that you would like. When you purchase the classes, we provide you with the slides and our notes. I've assisted hundreds of candidates pass CFA exams, and I look forward to also helping you through the CFA program. I've put in 2 testimonials in the slide over here, and we also have a testimonials page on our website that you can review. I look forward to seeing you soon, and all the best.